Let's kick things right off with a chart that should make any equity analyst sit up and take notice. Look at this staggering gap. We're talking about Shell posting a massive $19.3 billion profit for 2025, right next to BP scraping by with just $1.3 billion. When you have two supermajors operating in the exact same global macro environment and you see an $18 billion spread, well, it tells you one company is executing flawlessly and the other is staring down a serious crisis. That gap perfectly sets up why this explainer on BP's current structural and financial situation is so absolutely essential. We aren't just looking at a bad quarter here. We're looking at an existential make-or-break moment for a true titan of the industry.
Welcome to this explainer on BP's corporate turnaround and how exactly they are trying to earn their place back in the market.
Part 1. The Supermajors Struggle. Let's look at the operational and financial challenges currently facing BP.
Diving straight into the fundamentals, the sheer volatility BP has faced recently is wild. Remember, BP isn't some scrappy tech startup. This is a massive operation producing over 2 million barrels of oil equivalent a day, running 21,000 service stations with a footprint spanning 61 countries. But, as we know, massive scale can also mean massive bloat. Just look at that drop. Back in 2023, riding the wave of high energy prices, BP brought in over $15 billion in net income on $213 billion in revenue. Look what happens in just 24 months. By 2024 and 2025, revenue stagnates at $189 billion, and net income absolutely craters to just over $1 billion. The big takeaway for us as analysts? BP's profitability wasn't actually resilient. It was overly dependent on perfect market conditions.
And as you well know, Wall Street absolutely does not forgive that kind of structural weakness. That plunging profit directly translates to what you're seeing here, a nearly 22% drop in BP's share price over the past year. Investors are voting with their wallets, and it's a massive flashing signal of deep lack of confidence in management's ability to navigate lower price environments and fix their internal complexity.
Part 2. A new leadership era and the recent C-suite shakeup. Now let's see how all this financial pressure builds into incredible turbulence at the very top. This timeline illustrates the chaos perfectly. Meg O'Neill, stepping in as chief executive in 2026, makes her the third CEO in less than 5 years. Think about that from a capital allocation perspective for a second. For a supermajor that plans capital projects measured in decades, having a revolving door at the CEO office creates massive strategic whiplash. The mandate for O'Neill wasn't just to keep the seat warm, it was to stop the bleeding.
That brings us to the crucial Q2 2026 earnings call, right at Meg O'Neill's 100-day mark as CEO. Historically, you'd expect a new CEO to use this honeymoon period to offer some vague promises of synergy and future growth. But O'Neill? She decided to bypass traditional corporate spin entirely. She chose the hard path.
Part 3. Facing the Hard Truths through a remarkably blunt diagnosis.
O'Neill starkly admitted to lagging operations with this incredibly direct quote. Performance in the first half of the year has not been where it needs to be. And she wasn't just talking about the balance sheet. She noted an unacceptable increase in Tier 1 process safety events, which are the most serious kind of operational leaks or fires. Most tragically, she pointed to a fatality at a Castrol blending plant in Turkey. She made it explicitly clear to analysts that financial turnarounds mean absolutely nothing if the operational foundation is cracking.
And this brilliantly illustrates the cultural shift she is demanding. I want challenge to be welcomed, disagreement surfaced early. This is a direct attack on the bureaucratic yes-man culture that so often plagues massive century-old companies. As investors, we love to see candid shareholder communication like this. She is demanding transparency in both good times and bad, insisting that bad news must travel faster than good news if they want to survive.
Another hard truth she faced head-on was the balance sheet itself, specifically BP's massive $22.3 billion in net debt. When commodity prices drop and you have that much debt to service, it eats up the cash flow that should be going to shareholder growth or clean energy investments. That debt was acting as a giant anchor, dragging down their resilience and destroying their margin of safety.
Part 4. The turnaround strategy and a clear roadmap to recovery.
Using this fantastic boxing metaphor, she laid it out clearly. We need to get BP fit for the weight class we are in today. It's a pretty profound admission. BP has to stop acting like the untouchable titan it was back in 2005 and recognize its current reality. It must shrink its financial obligations and its sprawling portfolio to align with its leaner European peers.
To do exactly that, she outlined this strict 5-point plan.
The days of rubber stamping every pet project are totally over. Now, every single dollar of capital must fiercely compete to maximize cash flow and returns. You see, simplify the portfolio and invest with discipline right up at the top. It's a clear mandate to clear out the noise.
And we can see this discipline already in action. They aren't just talking about simplification, they are actually executing it. BP is actively marketing major assets like Archaea Energy, which is a U.S. renewable natural gas business they only recently acquired, and they're even putting their legacy North Sea business on the block. They exited the Bay du Nord project entirely because it didn't meet the return thresholds, and they completed the sale of the German Gelsenkirchen refinery to shed cost intensity. They are essentially amputating parts of the business to save the whole.
Part 5. Q2 2026 financials at a glance and the early signs of a pivot.
So the crucial point for us analysts is that yes, they actually delivered strong quarterly execution here. Look at these numbers. $5.7 billion in underlying profit, which is up $2.5 billion from just the previous quarter. They generated nearly $11 billion in operating cash flow, which allowed them to knock $3.1 billion off that massive debt pile we talked about earlier. And for the shareholders who suffered that 22% drop, they got a 4% increase in the dividend per share. It's a strong signal that the medicine might just be starting to work.
Now, a truly fascinating metric to watch here is ROCE, or Return on Capital Employed. This is O'Neill's North Star, and honestly, it should be ours too when evaluating this turnaround. It's no longer just about how much top-line revenue you bring in. It's about how efficiently you use your capital to generate actual profit. Management is targeting specific units with rigorous new performance programs to boost this exact number. For example, Travel Centers of America, which they bought for over $1 billion back in 2023, is now under a microscope to ensure it actually pulls its weight in the portfolio.
Part 6. Righting the ship by fixing culture and cash.
This single phrase right here is the thematic anchor of the entire turnaround. Every part of the company needs to earn its place. It proves that historical legacy will no longer protect underperforming assets. Whether it's a 100-year-old oil field in the North Sea or a brand new renewable natural gas plant, if it doesn't generate cash and improve returns, it's gone. Sentiment has been entirely removed from the capital allocation process.
As we wrap up this explainer, I'll leave you with this thought to chew on. We've seen the brutal honesty, we've seen the strict 5-point plan, and we've seen the very first signs of positive cash flow momentum. But turning around a company of this sheer size is literally like trying to turn an oil tanker in a stormy sea. Can this 117-year-old giant permanently change its culture, successfully execute this massive pivot, and actually punch in its new weight class? Only time and the next few earnings reports will tell. Thanks for joining me today.